In 2008, while the S&P 500 crashed 37% and most hedge funds lost everything, Ray Dalio's Pure Alpha returned positive 14%. His secret? A 7.5% gold allocation he's held since 1996 that most investors completely ignore.
September 15, 2008. Lehman Brothers just collapsed. Ray Dalio is sitting in his Westport, Connecticut office watching every screen flash red. The Dow is down 500 points, banks are failing, hedge funds are liquidating everything. His phone rings. It's a pension fund client, panicking. "Ray, what do we do? Should we sell everything?" Ray leans back, looks at his portfolio allocation, and here's the thing. He's not panicking, because while stocks are cratering and bonds are seizing up, one position in his portfolio is doing exactly what it's supposed to do: gold. That 7.5% allocation he's been holding since 1996, the one everyone laughed at during the bull market, the one people said was dead money, it's up, significantly up, acting as insurance exactly when he needs it. "Don't touch the allocation," he tells the client. "Let the system work." By the end of 2008, Pure Alpha is up 14%, positive, while the market is down 37%. And that gold allocation? It wasn't about predicting anything. It was about systematic protection. Here's what nobody tells you about Ray Dalio's gold strategy.
Okay, let me take you back to 1996. Ray Dalio is 46 years old. Bridgewater is managing $4 billion. He spent 15 years building systematic investment strategies, and he's working on something new, something he'll eventually call the all-weather portfolio. Now, here's where most people get gold wrong. They think Ray Dalio holds gold because he thinks gold is going up. That's not it at all. That's not even close to why he holds it. Let me explain what he actually discovered. In 1996, Ray is studying historical economic cycles. He's looking at the 1920s, the 1970s, the Great Depression, and he notices something fascinating. There are 4 distinct economic environments that repeat throughout history: rising growth with rising inflation, rising growth with falling inflation, falling growth with rising inflation, that's stagflation, and falling growth with falling inflation, that's depression. Every asset class performs differently in each environment. Stocks love rising growth. Bonds love falling inflation. But here's the problem. What do you hold when you get stagflation, when growth is falling and inflation is rising? That's the 1970 scenario. Stocks crashed, bonds crashed, everything crashed, except one thing. Gold went up 10 times. Not because gold is magical, but because when you have stagflation, it means currency is losing value faster than the economy is growing. And gold is currency insurance. It's what people run to when paper money becomes questionable. Ray realizes something huge. If you want a portfolio that works in all weather conditions, in all 4 economic seasons, you need an asset that specifically protects you during the one environment where everything else fails. That asset is gold. But here's where his genius shows up. He doesn't just say, buy some gold. He asks, how much? What's the mathematically optimal allocation? And that's where the 7.5% comes from.
So why 7.5%? Why not 5? Why not 10? Why that specific number? This is where Ray Dalio's risk parity approach becomes absolutely critical. Let me break down how he thinks about this, because most people completely miss this. Traditional portfolio theory says put 60% in stocks, 40% in bonds, the 60-40 portfolio. But here's the problem Ray identified. That portfolio isn't actually balanced by risk, it's balanced by dollars. Think about it. Stocks are way more volatile than bonds. So even though you have 60% in stocks and 40% in bonds by dollar amount, you actually have about 90% of your risk in stocks. The portfolio is completely dominated by equity risk. Ray's insight: you should balance by risk contribution, not by dollar amount. So when he's building the all-weather portfolio, he's thinking, what's the risk contribution of each position? How do I balance across all 4 economic quadrants? He starts with the basic framework, 30% stocks, but then he needs 55% in bonds, 40% long-term, 15% intermediate to balance the risk from equities. The bond allocation is huge because bonds are less volatile, so you need more of them to contribute equal risk. Then he gets to the inflation protection piece. This is where gold comes in, and commodities. He runs the math, historical volatility, correlation matrices, risk decomposition, and he discovers that 7.5% gold plus 7.5% commodities gives him the optimal inflation protection without over-concentrating in any single asset. That 15% total, split between gold and commodities, is what balances his inflation risk against his deflation risk. But here's the key insight about gold specifically. Gold has negative correlation to financial assets during crisis periods, meaning when stocks and bonds both crash together like 2008, like March 2020, gold typically rises. It's the ultimate crisis hedge. So that 7.5% isn't arbitrary. It's mathematically derived from decades of historical data, correlation analysis, and risk parity optimization. And once Ray figures this out in 1996, he never changes it. 7.5% gold, every portfolio, every client, non-negotiable.
Fast forward to 2008. This is where the theory meets reality in the most brutal way possible. Let me paint the picture. September 2008, Lehman Brothers collapses. AIG needs a bailout. The entire financial system is on the verge of total collapse. Credit markets freeze. Nobody knows which banks will survive the week. Stock market? Down 37% for the year. Worst performance since the Great Depression. Hedge funds? The average hedge fund lost 19% in 2008. Real estate? Collapsing. Corporate bonds? Crashing. It's a complete financial meltdown. Everything is going down. Except gold is up 5% for the year. And in the fourth quarter, the worst quarter of the crisis, gold is up 25%. Ray Dalio's Pure Alpha Fund, up 14% for the year. Positive 14, while everything else is burning. Now, gold wasn't the only reason Pure Alpha was up. Ray had systematic short positions. He had currency trades. He had been preparing for a debt crisis. But that 7.5% gold allocation, it did exactly what it was supposed to do. It provided positive returns during a crisis when both stocks and bonds were down. Let me show you why this matters so much. Most people think, oh, gold is just for crazy people who think the world is ending. That's not what Ray Dalio thinks at all. He thinks about it like this. Gold is insurance. You don't buy insurance hoping your house burns down. You buy insurance because if your house burns down, you need protection. The 7.5% gold allocation costs you something during normal times. Gold doesn't pay dividends. It doesn't pay interest. It just sits there. During the bull market from 2009 to 2019, gold underperformed stocks massively. But Ray doesn't care because he's not trying to maximize returns. He's trying to maximize risk-adjusted returns across all economic environments. And you cannot achieve that without crisis protection. 2008 proved his framework. While traditional 60-40 portfolios lost 20 to 30%, the all-weather portfolio with its 7.5% gold allocation lost way less. It did exactly what Ray designed it to do: survive.
Okay, let me explain the economic mechanism behind why gold actually works as crisis insurance. Because if you don't understand this, you'll panic and sell at exactly the wrong time. Gold is not an investment. Let me say that again. Gold is not an investment. It doesn't produce anything. It doesn't generate cash flow. A bar of gold today is the same bar of gold in 10 years. It doesn't grow. It doesn't innovate. It just sits there. So why does Ray Dalio hold it? Because gold is the anti-currency. It's what people run to when they lose faith in paper money. Think about what money actually is. It's a claim on goods and services. A dollar bill is not valuable because of the paper, it's valuable because everyone agrees it can be exchanged for stuff. That agreement is based on trust in the government that issues it and the central bank that manages it. But what happens when that trust breaks down? What happens when the central bank prints too much money? What happens when governments run massive deficits and devalue the currency? That's when gold shines, because gold can't be printed. There's a finite amount of it. Central banks can't create more when they need it. It's the ultimate store of value when paper currency becomes questionable. Ray Dalio learned this by studying the 1970s. Nixon took the U.S. off the gold standard in 1971. Suddenly, dollars weren't backed by anything except trust. And what happened? Inflation exploded. The government printed money to fund the Vietnam War and social programs. Currency lost value. Gold went from $35 an ounce in 1971 to over $800 by 1980. That's not because gold became more valuable. It's because dollars became less valuable. Now here's what Ray realized. This pattern repeats. Every time governments get into too much debt, they have two choices: default or inflate, and most choose to inflate, print money, and devalue the currency. That's what happened in the 2008 financial crisis. That's what happened during COVID in 2020. And every single time that happens, gold goes up, not because gold is magic, but because it's the mathematical inverse of currency devaluation. So when Ray holds 7.5% gold, he's essentially saying, I don't know when the next currency crisis will happen, but I know it will happen eventually, and when it does, I want to be protected. That's insurance thinking. That's systematic risk management.
Let me show you how gold fits into Ray's complete all-weather framework, because you can't understand the gold allocation in isolation. The all-weather portfolio is built on one core principle: balance across economic seasons, those four quadrants I mentioned earlier: rising growth plus rising inflation, rising growth plus falling inflation, falling growth plus rising inflation, falling growth plus falling inflation. Each asset class performs well in certain quadrants and poorly in others. Stocks love rising growth. Bonds love falling inflation. But you need something for that stagflation quadrant, falling growth with rising inflation. That's where financial assets typically fail. So here's the complete allocation. 30% stocks, that's your rising growth exposure, 40% long-term bonds, those 20-plus year bonds, 15% intermediate bonds, 7 to 10-year bonds, that's your deflation protection, total 55% in bonds, then 7.5% gold, 7.5% commodities, that's your inflation protection. Now watch what happens in each economic environment. In normal times, rising growth, low inflation, your stocks and bonds both do okay. The portfolio generates that 7 to 8% annual return. Nothing spectacular, but steady. In deflation, falling growth, falling inflation, your bonds explode higher, the long-duration bonds especially. They offset losses in stocks. 2020 pandemic crash, bonds saved the portfolio. In inflation, rising prices, your gold and commodities rise. They offset losses in bonds from rising rates. 1970s, gold went up 10 times. In stagflation, the nightmare scenario, gold is your savior. When both stocks and bonds are down, gold typically rises because currency becomes questionable. That's the genius of the 7.5% allocation. It's precisely sized to provide protection without overconcentration. Too little gold, say 3%, and you don't get enough crisis protection. Too much gold, say 15%, and you drag down returns during normal times when gold underperforms. 7.5% is the sweet spot, enough to matter when you need it, not so much that it kills you when you don't. And Ray rebalances systematically. If gold goes up and becomes 8 or 9% of the portfolio, he sells some. If it drops to 5 or 6%, he buys more.
always returning to that 7.5% target. No emotions, no predictions, just systematic rebalancing.
So let's get practical. How do you actually implement this if you want to follow Ray Dalio's gold allocation strategy? First, calculate your target, 7.5% of your total portfolio value. If you have $100,000 invested, that's $7,500 in gold. If you have $1 million, that's $75,000 in gold. Now, you have choices for how to hold it: physical gold versus paper gold. Physical gold means actual gold bars or coins. You can buy American gold eagles, Canadian maple leafs, gold bars from refineries. The advantage, you actually own it. Nobody can devalue it, nobody can take it away. The disadvantage, storage, security, insurance, plus dealing with dealers who charge premiums and spreads. Ray Dalio's Bridgewater uses primarily gold futures and ETFs for their allocations. They're not storing physical gold bars. They want liquid, tradable positions they can rebalance systematically. For most people, an ETF like GLD or IAU is the practical choice. You can buy it in your brokerage account just like a stock. The fees are minimal, around 0.4% annually, and you can sell instantly if you need to rebalance. But here's the critical part, and this is where most people fail. You have to rebalance systematically. That means when gold goes up a lot, you sell some. When it drops, you buy more. Always returning to that 7.5% target. Let me give you an example. Say you start with $100,000 portfolio. $7,500 in gold, the rest in stocks and bonds following the all-weather allocation. A year goes by. Stocks are up 20%. Gold is flat. Now your portfolio is worth $110,000, but gold is still $7,500. That's only 6.8% now. You're underweight gold. What do? You rebalance. Sell some stocks, buy more gold. Get back to 7.5% of the new portfolio value. That's $8,250 now. Most people can't do this. It feels wrong. Stocks are going up. Why would I sell winners to buy more gold that's doing nothing? But that's exactly what systematic risk management requires. You're not trying to predict, you're maintaining balance. And that discipline, that systematic rebalancing, is what saved Ray Dalio in 2008 and has worked for 25 years since.
Let me tell you the biggest mistakes people make with gold allocation, because I've seen these patterns over and over. Mistake number 1, timing. People try to predict when gold will go up. They wait for a better entry point. They think they'll buy gold when they see inflation coming. That's backwards. By the time you see inflation, gold has already gone up. The whole point of Ray's 7.5% allocation is that it's systematic. You hold it all the time. You don't try to time it. Mistake number 2, concentration. People hear that Ray Dalio likes gold, so they put 20 or 30% in gold. Huge mistake. 7.5% is optimal. More than that, and you're overweight a non-productive asset. You'll dramatically underperform during bull markets and stocks. Mistake number 3, emotion. Gold goes up 50% in a year, like it did in 2020, and people get excited. They increase their allocation. Or gold goes nowhere for 5 years and people get frustrated and sell. Ray Dalio doesn't do this. He's mechanical. 7.5%. Always. Whether gold is soaring or crashing, the allocation never changes. Mistake number 4, confusing gold with gold mining stocks. Some people buy gold mining stocks thinking they're following Dalio's strategy. No, gold mining stocks are equities. They're correlated with the stock market. They don't provide the same crisis protection as physical gold or gold ETFs. Ray holds actual gold exposure, not gold miners, not gold royalty companies, just gold. Mistake number 5, ignoring the rest of the portfolio. People focus on the gold allocation and forget that it only works as part of a complete all-weather framework. Gold alone doesn't make a portfolio. It's the combination of stocks, bonds, gold, and commodities balanced properly that creates all-weather protection. You can't just add 7.5% gold to a traditional 60-40 portfolio and call it good. The whole allocation needs to be optimized together.
So where are we right now in December 2025? And what would Ray Dalio say about gold today? Well, we know what he's actually saying because he publishes his views regularly. And his position hasn't changed. He still holds that 7.5% gold allocation, still rebalances systematically, still treats it as non-negotiable insurance. Here's why it matters right now. We're in a historically unusual environment. Government debt is at all-time highs. The U.S. federal debt is over $35 trillion. Central banks printed trillions during COVID. And inflation, real inflation, not the official numbers, has been running hot. In this environment, Ray's currency devaluation insurance becomes even more important because the way governments typically deal with too much debt is through inflation. They print money and devalue the currency. That's the historical pattern. Gold in 2025 is trading around $2,000 per ounce, up from around $1,200 5 years ago. Why? Because investors are worried about currency devaluation. They see the debt levels, they see the money printing, they're buying insurance. Now, does that mean gold is about to explode higher? Maybe, maybe not. Ray Dalio doesn't make predictions like that. He doesn't need to because he holds the allocation regardless. But here's what he has said publicly. He's concerned about debt sustainability. He's concerned about currency devaluation. He's concerned about the potential for another crisis, and in that environment, gold becomes even more valuable as insurance. Think about it like this. If you own a house in a high-risk fire zone, you pay more for fire insurance. You don't skip it because fires haven't happened yet. You increase your coverage because the risk is elevated. That's where we are with gold right now. The risk of currency crisis, of inflation, of financial system stress, those risks are elevated, which makes the 7.5% allocation not just sensible, but essential.
So here's what I want you to take away from this. Ray Dalio's 7.5% gold allocation isn't a prediction. It's not a bet. It's insurance. He doesn't hold gold because he thinks gold is going to the moon. He holds it because he knows that at some point, he doesn't know when, currencies will face stress. Governments will print too much money. Inflation will spike. Financial assets will crash together. And in that environment, gold will do its job as crisis protection. The genius is in the systematization. 7.5%, always, rebalanced mechanically. No emotions, no predictions, just math and discipline. Most people can't do this. They get excited during bull markets and reduce their gold. They panic during crashes and buy too much. They try to time it. They deviate from the allocation. But Ray built a $150 billion hedge fund by being systematic, by following principles, by letting math override emotion. And the 7.5% gold allocation is one of those non-negotiable principles. It's worked through the 2008 crisis, through the 2020 pandemic, through multiple inflation cycles, and it'll work through whatever comes next. Because it's not about predicting the future, it's about being prepared for all possible futures. That's what all-weather means. That's what systematic risk management means. Now I want to hear from you. Do you hold any gold in your portfolio? Have you thought about systematic allocation? How do you balance crisis protection versus return maximization? Drop a comment below. If you found this valuable, hit that like button and subscribe. We're releasing new Ray Dalio deep dives regularly, and you don't want to miss them. I'm your narrator. This is legendary investor Ray Dalio, and I'll see you in the next one.